I want to bring in Hillary Kramer. Hillary is the Chief Investment Officer at A&G Capital Group. Good to have you with us. Can you explain why the shares of Amazon would be up 8% in after-hours trading when, as Cory just described, we're talking about profit margins that are more like department stores, not tech companies?
And that's right. Pimm, one day, Amazon is going to be like Walmart in terms of margins, but for right now, Amazon has pricing power over the big box stores. And the market was really looking at Kindle and, of course, ebook sales, and ebook sales being up 70%, even though hard physical books were only up 5% in terms of revenue for the quarter. That was enough. First, we saw that knee-jerk, of course, the Amazon shares down, but then the market realized that for right now, Amazon is the category killer. And with that, all that pricing power and the breadth of other networks that they have within their system, this is really the future for the next 4 to 6 quarters. And I believe Amazon certainly will be above $300 a share, going probably towards $350 in this bull market that we're in for at least the next quarter.
But you talk about it as a category killer for the next, what, year, 2 years, 5 years? I mean, they're not going to put Walmart out of business, are they?
No, certainly Walmart was going to stay in business, and Amazon eventually, it's going to catch up with Amazon, and those margins will continue to contract. We're going to see that. But for right now, there's been so much bearishness around Amazon, and Amazon has also been underestimated and not loved the way we've seen with Apple. So in many ways, it's really just the market playing catch up with a company like Amazon. And that's why we're seeing it. And plus, the market wants to melt higher right now, Pimm. That's what's going on. Companies are hitting higher highs.
Well, for example, we had the results from Pfizer today. But just talk a little bit more about Amazon. I want to get your thoughts, Cory, on who owns Amazon shares. You were saying something interesting about the workforce at Amazon and how much stock they own. That can affect the price movement.
Yeah, Amazon's a really interesting company with an interesting corporate culture. And one of the things about that culture, and I can't wait a very, very long early tease, but our friend Brad Stone at Bloomberg Business Week is writing a book about Amazon and about Jeff Bezos, and I hope that a book will be out sometime in the next year. And we've been talking about some of the things he's been learning. One of the things about this company is they've got a lot of smart people who work there who are getting paid below industry standard salaries. They make up for that with these restricted stock grants. But I think that to some degree, there is operational risk at this company if the stock would ever people who are making up for lower pay, and indeed it's helping Amazon's margins, would in fact leave the company, and they wouldn't have the best and the brightest as they do today.
Yeah, now, Pimm, it's very interesting. There is a difference, it's subtle, but between CapEx spending and margins. Capital expenditures really kept the stock of Amazon down for so many quarters. Analysts, investors were bearish because of all this money, billions of dollars being spent on fulfillment centers abroad, including in China, and the fulfillment centers across the United States. But clearly, that is finally paying off. And then, of course, we had the concern about the 10% California tax. That Amazon, that should have been some kind of overshadow to the stock and to the shares, but certainly Amazon was able to overcome, the impediment of being taxed.
Cory Johnson.
Yeah, but I want to. The capital expenditures for this company continue to be very aggressive. They've picked up capital spending in a very big way. In the last quarter, spending $2 billion in CapEx. That compares to the previous year, fourth quarter, of just $550 million. So they are accelerating the capital spend. They've said they're going to continue to do that. Some of that surely is Amazon Web Services, not just distribution centers. They now have 80 distribution centers all over the world. They announced a new one being opened up in Italy just last week. But look, the capital expenditures of this company are going to have to pay off in a lot bigger ways than they already have for them to be worth the amount of money they've been spending. Because to get to an operating, if you're going to spend $2 billion in a quarter in capital expenditures and only get an operating profit of $400 million, that's not paying off yet. They've got a long ways to go.
Hillary, got a response to that?
Yes, I certainly do. I'm glad we're talking about the CapEx. It still is significantly better than anyone expected. There was concern that Amazon could actually come down. I mean, that the entire empire could fall apart with these huge bets, especially these fulfillment centers that are same day in China, okay, same day delivery. So Cory makes a really good point. That's why the CapEx has to be focused on and was a big area of focus. But remember, almost all NASDAQ stocks, with the exception of Apple, it's going going up, and this is a market that right now has reached an irrational level with this melting upwards. So again, right now, Amazon's going to go higher. Your short-term investor trader, you want to bet on Amazon and overlook issues like, as I said, this CapEx, which is significant.